Good afternoon and welcome to the September 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, September 24th, 2023, and the time is 1:11 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. We'll start the meeting by calling the roll. Anthony Giordano.
Present.
Frank Cirabella.
Present.
Corinne Apollon.
Present.
We have a quorum. I'd also like to note for the record that alternate executive committee member Greg Faulkner is in attendance, and board members Mahesh Desat, Allison Hirsch, Effie Zachary are also in attendance, either in person or via WebEx. The first item of business is to consider the minutes from the executive committee meeting held on August 8th, 2023, a summary of which was included in your packets. May I have a motion to consider? May I have a second?
Second.
Any discussion on the August 2023 executive committee meeting minutes? Motion to approve? Second?
Second.
All in favor, please say aye.
Aye.
Any opposed? Any abstentions? Motion carries. The next item on the agenda is from the Fiscal Operations Department. A resolution to extend an agreement with Oracle America Incorporated for accounting enterprise resource planning software at an additional cost not to exceed $194,699.70. In June 2022, the board authorized the executive committee to approve contract amendments and extensions at a cost of above $100,000, but not greater than $500,000. May I have a motion to consider?
So moved.
Thank you, Tony. May I have a second? Chitra, can you tell the committee about the resolution?
Thank you, Antonio. Good afternoon, everyone. My name is Chitra Subramaniam. I'm the Director of Fiscal Operations. This is a request to renew an agreement with Oracle for NetSuite for 3 years. NetSuite is a cloud-based accounting platform. We currently use NetSuite. The estimated cost for 3-year renewal is $194,699. Thank you. Happy to take any questions.
Any questions for Chitra? Thank you. And once again, the resolution is to extend an agreement with Oracle America Incorporated for accounting enterprise resource planning software for an additional cost not to exceed $194,699.70. May I have a motion to approve?
Motion.
Thank you, Corinne. May I have a second?
Second.
Thank you, Tony. All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? The motion carries. The next item on the agenda is a recommendation pertaining to strategic asset allocation. May I have a motion to consider?
So moved.
May I have a second? Thank you. Before I turn it over to Siegel Marco Advisors, who will give the bulk of the presentation, and the Bureau of Asset Management for their thoughts, I wanted to do two things. First, I wanted to remind the committee that the entire board actually must approve strategic asset allocation. Today, we are just asking for your recommendation to the rest of the board as the executive committee. In addition, with every asset allocation discussion, I wanted to remind everybody kind of all the work that's been done prior to getting to this point. And I'm going to share my screen because I think you will recognize every single last one of these slides because we've given them before. All right, we've given this presentation before, but it's really kind of just a reminder of kind of where we've been and why we've arrived at this particular point. In addition, since we had questions regarding cash management specifically at the last meeting, we have Chief Investment Officer Steve Meyer to discuss the capabilities and enhancements at BAM with regard to cash management, because within the recommendation, that is a new asset class. So really quickly, we went through the historical asset allocations, but in general, if there's a theme over the past 15 years, it's been that we've increased the amount in alternatives and decreased the amount in public markets since the financial crisis. In public equity, we've seen major declines in developed markets, developed Europe and Japan in particular. That was mostly due to basket clause considerations, while being able to keep our overall equity allocation relatively constant. In public fixed income, we shifted to take more credit risks, and we balanced out our core risks. So in the Bloomberg aggregate, we're overweight government bonds. We've balanced that out. And we increased our allocation to high yield bonds over the last 4 asset allocations. Kind of alternatives have seen increases across the board. Private equity at the time almost doubled, saw big increases in real estate. We started an infrastructure program in, I believe, 2011 and 2012, and then we started a private credit program in 2020. seen this before. This decision comes under very different economic circumstances. So you can see the changes with regard to the Fed funds rate from the June 2009 asset allocation and today. Seen changes in inflation from between 2009 and today in growth and in the 10-year treasury. So we're making this decision in a very different economic circumstances. We're also making this decision with very different financial conditions for the plan. So again, our market value and actuarial value of assets funded ratio in June 2009 was 54 and 68% respectively. But I wanted to, obviously the big changes are in the funded ratio between those time periods, but pay attention to the column on the right again, that our net cash flows through 2009, 2012, 2016, and June 2020 were all positive. So BERS, again, was taking in more in contributions between employer and employee that we were paying out in benefits. If there's one column that's the most important, I think actually is that column, right? Is that, again, we always have a fighting chance when you're having a large increase or you don't have to sell to pay benefits. And so I think if you think about the increases across the board on funded ratio, don't overlook that component. And so again,
Inherently, a more mature fund will have negative cash.
yes, absolutely, 100%. And so yeah, don't think about it as a bad thing. Think about it as relative maturity of the plan, and ultimately but if you think about the differences in outcomes over the 15-year period between the systems or between other pension funds and ours, obviously don't discount that. A lot of plans are already paying out, have been mature for far longer than us. So they've been paying out more in benefits for a lot longer. And so that's a key component to kind of where we're at today.
And this is more for ratification. What are the primary purposes for that imbalance? What is it? Is it just members not being accounted for yet? Members falling off the plan?
I would say, certainly you think about our plan in particular, just our population. I think that's a population and demographics. We, think about it like for a long time, part-timers couldn't join a pension and they could. Our demographics look a lot different. And our members don't make as much, right? Like that's another thing. So their actual pension benefit in and of itself isn't as long. So there's a lot of different demographic reasons for why that is. So, but again, the key takeaways, we made a ton of progress. And over the past few years, we had an aggressive asset allocation. We had the leverage effect, cash flow positive, the changes to benefit structure in Tier 6. And thinking about, again, I'll skip over the rest of it. You have this information, but remember, we went through those key takeaways and what that would lead to. Effie?
Do we model each tier separately? We have 6 tiers, or do we aggregate it all together when we?
So and I'll get to kind of what the actuary went through in his conversation with you all. But they're aggregated. They're looking at a separate tier and then kind of rolling it all together. And so they'll look at the overall benefit structure. How many lives are in? I don't think do we have any Tier 1 members left? No. Yeah, I was like,
There are 12 left. 12.
We're 12. Well, okay, 12 Tier 1. Thank you, Daniel. So you have 12 Tier 1 members left. So that gold-plated standard versus kind of like down the line. But so just so that's all kind of modeled out. And I think Tier 6 has done a lot. Cash flow Tier 6 has done a lot of the work in kind of changing the health of the plans. The other key takeaways, again, more alts, less public equity, more US, less international, and then we're in a better financial position. I went over that. Capital market expectations, again, went over that. And this was really through the Siegel-Marcos analysis. Salil's analysis on investment liability risk, which I think is incredibly novel and helped us get to where our recommendation today, and how do we take into account parameters that are not captured by mean variance optimization. And worrying about instances where is it like, and if I had to characterize last asset allocation versus this, is the cost of being wrong on the upside versus the downside. And when you're 54% funded but cash flow positive, the upside is a lot more, like you have to kind of reach to get to where you want to be. 100% funded with negative cash flows, the risks of being wrong change. And so that kind of all filtered into the asset allocation assumptions. And really that was we're gonna lower the risk of the portfolio, right? That, I think that's kind of the, or certainly maintain risk or not increase risk in the portfolio, where it'd be increasing risk over the past 15 years. The actuary did a kind of a teaching that I thought was as good as a job as you could possibly do talking about actuarial issues. So went through actuarial basics, kind of ultimately what is the equation that if you had to kind of focus on anything, contributions plus investments equals benefits plus expenses. How the unfunded actuarial liability is calculated and what we do about it. And ultimately, how do we calculate the money that gets put into the plan, the normal cost for 1 year, the payment to pay off the unfunded actuarial liability, admin expenses, so us, and that equals the contribution rate. And really, I think the big thing is that big takeaways or consideration from that were numerous smoothing methods help spread market and actuarial risk over time. So we can worry less about 1 year than a individual investor. We take into account that's the entire point of kind of this intergenerational risk. And then amortization payments in 2033. Here, Sandy's harping on it all the time that cash flows are declining. And what does that mean, right? And how should we take that into account? So with that, I'm now going to turn it over to Siegel with setting that stage. So I'll load up their presentation, but before we get any questions, before we turn it over to Siegel.
Do we model the probability of the city not giving what they're supposed to?
No, that is impossible. So I mean, like, well, not impossible. I'd say that they are constantly required to put in their actuarial required rate every year. So that, I mean, that if you think about the difference between us and any other,
But in a lot of cities, they don't.
no, that's 100% true. 100% they don't. I mean, you have some clients that aren't required to, right? Like, but luckily we are, right? And luckily our employer and sponsor is required to put in every year.
So our modeling is always 100% assumption.
Yes.
Getting the money.
100%.
Never failed.
Allison.
I was just gonna say in response to what Effie said that unlike other states, the requirement is guaranteed in the state constitution, which is really where the protection lies in New York City and state.
And that makes
That's comforting.
It's an enormous difference. It's an enormous. It is. I mean, that's number one. I actually, if you're talking about capital, that's the number one. Like they have to put in the money every year. Thank you, Allison. So with that, I'll turn it over to sharing my screen. I'll turn it over to the folks at Siegel.
Good afternoon, all.
Yeah, I did close the stop the PowerPoint.
Too nervous to say last meeting.
I know, man. I mean, I thought this was gonna work.
There
All
you
right. Yep. There we go.
You go to, so let me set the stage. We've had multiple conversations with you all about asset allocation. Here. For the next one.
Yes.
Because asset allocation is one of the most important decisions that you will all make as a trustee. Research has said that mostly your return is coming from asset allocation, like 90% of your return is coming from the asset allocation that you all choose. And that this is your primary responsibility. I don't wanna go through everything that I said at the last meeting, but I am happy to answer questions in case there were any that we didn't answer at the last meeting. In summary, with the recommended portfolio that you see on this slide, it's the same one that you saw at the last meeting, the last column, recommended modified portfolio. We have a 50 basis points increase in cash, which we did not have in the past. The reality is that the portfolio has historically been managed with some allocation to cash to pay benefits. So we will, when we update the investment policy statement for you all, we have to assign now a benchmark to cash because now it becomes a strategic asset allocation. But in general, when you look at the fixed income total, you'll see that there is only a 1% total increase in compared to the target to fixed income. And that is because what Antonio mentioned, we are in a very different environment, an environment where yield came back and is providing you some return. So we're able to get some more yield out of this portfolio, and that increase by 1% also helped us reduce some of the standard deviation of the overall portfolio compared to the target. You will see a reduction or elimination of TIPS. TIPS used to be a 3% allocation. We are eliminating that allocation completely. That doesn't mean that you don't have an inflation hedge real assets allocation, and I have another slide that shows you that. But we're eliminating that. And then an increase into core fixed income where the yield is really coming from. In the equity portion of the portfolio, you will see that it is exactly the same total that we had in the past. The only difference is we have a higher US equity versus non-developed and emerging. So a little bit more of a domestic bias there in equities. And in the alternatives and real estate, even though the basket clause was increased to 35%, we're actually reducing private equity by 1%. And that also impacts your basket clause. So your basket clause in general, because of the changes to private equity, because of the changes in high yield, non-US developed and emerging market is gonna go down versus where you were at the prior target allocation. And in the bottom of the page, what you can see in comparison in terms of return, and look at the 10-year and the 20-year expected return for the portfolio, is that you see it's only a 10 basis points reduction in terms of expected return over the 10 and the 20-year, but a 50 basis points reduction in terms of standard deviation. So a very similar return expectation portfolio, just a lower risk going forward.
Sorry. And just to reinforce that, so really the goal of this asset allocation was to say, given that it's a very different environment, as Antonio was showing, such as global growth is different, it's different in different areas. You're getting, you're in a different interest rate environment, which means that you're getting a lot more, I'd say, fixed income. The goal of this asset allocation was to say, while you were still, the ship was steering in the right direction, you were heading towards your goal, and your overall goal is your return expectation that you're trying to get to. What we're trying to do with this is, given these new circumstances, how can we get you to that goal with less variability? And that's really what we mean by portfolio efficiency. Portfolio efficiency is getting to your return with the least amount of risk. And that's really what we're trying to do. And that was the main point that we were trying to guide this whole asset allocation. So,
Well, if we get out of balance with at what point do we need to rebalance? At what point, what triggers potentially if we get out of line by market conditions, by manager straying, whatever reason?
So the investment policy statement, which is the next step after you approve the asset allocation, has rebalancing ranges across each of the strategic asset allocations that you see here. So a lower band and a higher band. And that's what triggers any sort of rebalancing from an asset allocation
Different
perspective.
for each asset class.
Different for each asset class.
Steve, if you can comment on just the real quickly, on that question on rebalancing, on how, in practice, from the implementation perspective.
Sure. Absolutely, Antonio. Thank you. So we actually rebalance on a weekly basis on Wednesdays. And we don't take liberties. We're not taking tactical bets across any of the asset classes. Obviously, Siegel and Marco has put together what we think is a very good mix of portfolio mix of strategic asset allocation. We want to adhere to that and remain on what's called the efficient frontier. So on a weekly basis, we review market changes and where we are. It's also an integrated part of our process of managing cash. So we always have some element of cash that we manage for the benefit of the plan to meet both beneficiary payments, but also capital calls and private assets. And we do that on a weekly basis. Again, that's an integrated process. But rest assured, even though in the investment policy statement, it may indicate a fairly wide or wider degree of flexibility around those targets, we actually try to hit those targets pretty carefully. We take into consideration market timing, costs associated with execution. We want to be efficient, but again, we adhere to the targets that are given to us by the trustees.
To clarify that.
Question for Steve, actually. Steve, can you hear me?
Yes.
Hi. I just wanted to get a little bit better understanding. What does cash mean? Like repos, commercial paper, T-bill?
Great question. Yeah. Great question. So we've actually rebuilt, since I joined, we actually have increased our credit focus. and discipline around cash. So we actually hired a gentleman named Chris Holmes, who's now a senior investment officer here. He actually oversees the portfolio construction and the credit process. But to answer your question very directly, anything we invest in cash typically is very short, particularly for the pension plans. They're typically within 2 weeks. It concludes commercial paper, asset-backed commercial paper. We do diligence every one of the issuers, T-bills. And we're looking at potentially expanding the CDs and repurchase agreements, but all plain vanilla stuff, very high credit quality stuff. We have our own, as I said, credit process in place. And this whole process is integrated into how we rebalance the portfolios on a weekly basis.
Thank you. And I'll just remind you of a money market fund used to be called the reserve fund. How do we make sure we don't step into something like that?
Well, we're very careful. So most of our exposure, so let's say we didn't invest the cash that you have in the account. It actually goes into a government-only sweep vehicle at the custodian at State Street Bank. That yields about 20 basis points on average below market, below where we can invest the proceeds directly. So we actually undertake that in-house. So if for some reason that government sweep account has a higher yield, we'd leave it there. To answer your question more directly, though, we're very careful with any credit risk that we take in the portfolio. We keep everything short. For the most part, asset-backed commercial paper or commercial paper that we buy, it's all A1 plus P1 or A1 P1. A lot of those transactions are typically done just on an overnight basis. The exception may be on a Friday where we have exposure to Monday, but we're very, very careful and conservative in terms of how we manage the cash.
All right, thank you very much, Steve.
Steve, this is Tony. Question, in terms of the triggering of the rebalance, is it an automatic rebalance or do we have to be outside of the parameters of the IPS for it to?
Yeah, we do not have, so Tony, actually, there's a fairly wide berth and a fairly wide range for those targets, plus and minus. We don't actually look at those as we look at them every week, but we really try to hit that target. So if there's an 8% allocation to a certain asset class, we try to stay pretty close to that or very close to that. It's a little bit imprecise because you don't want to be exactly on all the time and have to incur a transaction costs to get there. But we do balance the costs associated with that. But we really try to hit those targets. We do not try to time the markets. We don't take tactical bets. We don't let things drift. We try to have a very disciplined approach in terms of how we manage the assets on behalf of the plan.
So we're doing a weekly rebalance to get as close to the number as possible. But then what is the what are the buffs for that, right?
Yeah, so for equities, I'm remembering, I think it's about 4% plus or minus. We typically are well inside of 2% and try to stay within 1% of that target. And the market moves around, so we don't want to incur costs. We do this in conjunction with the amount of cash we need to raise again to meet those benefit payments and capital calls. So it's all an integrated process. But again, we try to really hit those targets pretty consistently.
And that's all handled internally?
Yes, it's all handled within the Bureau of Asset Management. We have formal meetings and a voting process on every Wednesday morning at 9 o'clock where we go through, we review the liquidity needs of the funds, the pension payouts that are coming, any funding requirements or capital calls we may have relative to the distributions off of the private assets. And then we rebalance the portfolio, as I said, as needed, but typically we look at it more formally every week.
Thank you.
Thank you.
And then, so we wanted to show you, because there was a question on the next slide. So at the last meeting, there was a question. Oh,
Before we go to the next one, I just wanted to, I'm assuming standard deviation is regular two-sided standard deviation, right? I would love, if nobody minds here, I would love to have all for future information also include what is missing from my perspective as possibly one of the most important risk metrics, which is maximum drawdown. If we can have that in the future would be very helpful, I think.
So at the last meeting, one of the questions was, by the reduction of tips, are we eliminating all sort of real asset inflation hedge? So this chart that we are showing you here is showing you the strategic asset allocations divided by real asset inflation, growth, income, credit. And as you can see, there is a reduction to the real asset inflation hedge, but not an elimination. Growth stays about the same within 1%. And where you see the largest increase is really in the income portion of the asset classes, because we're increasing core fixed income. And then the next slides really shows you the basket clause. And really where you were at the last target allocation. We were really close to that 25% limit before it got increased to 35. And with this recommended modified portfolio, we're really bringing that down to almost 21%. So a lot of room from a basket clause perspective. Because at the last asset allocation, we was really reaching for that return in alternatives, and now we're in a different environment, so we can actually go down rather than go up in basket clause.
And actually, can I just add something? So one of the things that gave rise to the need to do a strategic asset allocation review was a change in legislation that really doesn't apply to BERS, given the very healthy funded ratio that you've been able to achieve over the course of time. I will say, though, I think given the magnitude of the changes in base rates or interest rates that we've had over the last 18 months with the Fed raising rates and longer rates moving up, I think that still would have required the same evaluation. So notwithstanding the fact that the impetus for the review was the basket clause change, it is a great opportunity for your plan to actually think about, and I think it's been well demonstrated by Siegel Markle, to de-risk the portfolio a bit, take some chips off the table, again, given that change in base rates.
So with that, what we're really recommending, and if you go back to that, yep. What we're really recommending is for the executive committee to, recommend to the board the recommended modified portfolio that we reviewed and analyzed with BERS staff, but also with the BAM staff.
Yeah, so one last thing to add, because I think there's one kind of question that's kind of embedded in this, is that given the health of the plan, why not reduce risk more, right? Like, why not, and I think, we had that conversation before. And, we always talk about the fixed TDA, right? That if there was not a fixed TDA in this plan, this would look different, I think. This would, we would have probably reduced risk even more. And I think when initial analysis that Vanessa and Frank did, that actually was borne out in that initial analysis. And I think this is where the marrying of the mean variance optimization with Salil's work really, really helps to sort of, with that fixed TDA and having to achieve that 8.25% return for that portion, what does that mean? And so we ultimately kept things the closer than we otherwise would have if the QPP was its completely own separate entity. And so really we're asking today for your support for the asset allocation presented to you all, which will then be presented to the Board of Trustees on Tuesday, September 26th.
So moved.
Thank you. Second. Thank you, John. And also want to note for the record that John Matterich is in attendance. So we have a second from there. Any final discussion? All right.
Just quick, it's more like a question / suggestion. Given how infrequently we do the asset allocations, we don't have to do it now and it's throwing a wrench into what we're doing, but just think about it. I would suggest if we can maybe move to an asset allocation model that is based maybe on interest rates, whatever benchmark makes sense, maybe Fed funds or something like that. And then we say, well, if Fed funds are at 6%, this is the asset allocation we want. But if like in 6 months from now, let's say there's a big recession and Fed funds are at like 0.5%, we want a different asset allocation. And I don't want to wait 3 years for us to say, well, let's change what we're doing. Is that something that?
And this is.
So while we do strategic asset allocation every 3 to 4 years, we do review the asset allocation annually when capital markets changes to make sure that the portfolio that these trustees have selected still is a valid portfolio. So that we are reviewing it every year that the capital markets, it's just you're not making an active decision to change it if there's nothing that warrants going out to do another strategic asset allocation.
Right, but I would feel that we would probably be better served and serve our members better if we are more dynamic as opposed to like waiting that long. And if nothing happens, then we didn't change anything. It's only if something happens.
What are the regulations regarding us if there is something of us making a
There's
change?
no restrictions on doing it as often or as frequently as you need to, and so you can answer this too as well in a second. But so there's no restrictions there. What I will say is that, all right,
Come on, bring it.
as much as possible, that like, all right, it is very different. Like you guys aren't paid to be here, right? And so when I say that it is getting everybody together, we are a massive ocean liner when it comes to this, because then even after this, then we have to start talking about implementation, right? And so I think if we were a family office or a foundation, then I would agree. I think given our structure, it is very difficult to, and maybe not necessarily, so, and I'll give you the big example, it may not even be advisable. So we smooth our returns over 6 years for contribution purposes. So we think about our actual risk, or like in that particular time period is, are we blowing up the city's budget by market? And most of that is dealt with through the actuarial process. And so now I will say that, and I think Salil made a recommendation, you can talk about it a little bit more in a bit, that around actually formalizing the frequency of review, and having some type of triggers with regard to asset allocation. So I don't know.
Yeah, there were a couple things I had recommended in addition to something that's time-based, something. One of them was, say, if the funding ratio in a given year falls 15%, something along those lines, 10 to 20%.
We don't have it in place now?
We don't have that in place, but I think that would be wise, because if that happens and then you're still on the hook to wait another 2 years before an asset allocation, you've squandered 2 years when there could be an opportunity and a huge risk waiting. So something along those lines. And there were a couple others. I don't have it sort of ready to discuss, right? But
I think you're right in that, like, it shouldn't just be time-based. It should be time and market conditions based. And I think that's also something that Steve's saying. So yeah, we have to agree. And I think we're already opening up the IPS to be changed anyway because of the new asset allocation. And so having some type of both time-based and market-based kind of triggers for a review, I think, is warranted.
There's also a balance between us being overreactive and market timing and acting as long-term investors. Right, so.
Exactly, yeah.
Stay the course.
You can always go through a strategic asset allocation review with Siegel Markle and the Bureau of Asset Management any time that the market moves significant. Like I said, it doesn't have to be tied to a 3 to 5 year time frame. Typically, 3 to 5 years is the length of time for a market or an economic cycle, but you can look at it more frequently. The only challenge that I would hear about having some sort of quantitative measures to trigger a review is that it seems, to me, it feels like market timing. And what we're supposed to be doing here is really very strategic, long-term oriented, not trying to time the markets, not taking tactical bets. It's not to say that we can't review it and we couldn't go through the process. If there's a dramatic occurrence in the marketplace or move in opportunities, yields, or return expectations. But again, I think the way we have this process set now with the consultant, working with the Bureau of Asset Management, other folks at BERS, I think it works and it makes sense. Again, there's nothing sexy about what we do. It's long-term oriented and strategic and risk controlled in nature.
Those triggers don't have to be market-based. They could be liability based too. They have some sort of budget proposal, legislative change.
There's parameters that figure.
There's so many dynamic strategies around exactly what Salil was talking about. So all of our dynamic strategies are really based on that funded status. But
Middle ground, it's finding.
And so, like I said, because the IPS is going to be up for revision just with the changes here, that can be part of that overall package. First, want to note for the record that Cherie Gibson is in attendance. Welcome, Cherie. So there was a motion and second already on for the recommendation for the asset allocation. So any other questions or discussion? Right. All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? All right, the motion carries. Thank you. So the next two items on our agenda are related to fund investment recommendations. For Public Officers Law, Section 105, 1H, executive sessions may be held if the discussion is about the proposed acquisition of securities or sale of or exchange of securities. With that being said, may I have a motion to enter executive session?
So moved.
May I have a second?
Second.
Thank you. All those in favor of moving into executive session, please say aye.
Aye.
Any opposed? Any abstentions? The motion carries. Stop the recording. All right, so we are now back in public session. And then before we begin the last two items, I'll report on executive session.
Thank you,
In
Jim.
executive session, the committee approved a commitment to a real estate, tabled a commitment to a real estate fund and approved an incremental commitment to a real estate fund. Our next item is for discussion, considerations for the private equity portfolio. Should the Board of Trustees approve the strategic asset allocation? Do I have a motion to consider?
So moved.
We have a second.
Second.
Thank you. Thank you, Tony. The recommended asset allocation has a few changes with regard to the relative amount of credit risk, and we are taking also our geographic exposure. But probably I think the biggest decision is how we're going to implement private equity moving forward. Our overall commitment pace is going to decrease over the next several years. And combined with our minimum sizing that we have in the investment policy statement and our ambitions with regard to diverse managers and climate solutions, we have to be thoughtful on how we move forward in the portfolio. So today's presentation is not a recommendation, but we did want to prepare the committee on how to think about portfolio construction in the near future. And for that, we have Sandra Vitals from Axia to talk about a few considerations with regard to the portfolio. So let me.
Take that down. You could get yelled at when you're left.
I can also spitball without the PowerPoint. if needed, So.
There you go. All right, here we are.
Kind of everything's just new authentication.
Yeah, so as Antonio mentioned, this is really, if you will, a thought exercise to think about potentially kind of which managers you might consider keeping going forward and where you may not want to re-up in light of what you currently have, which is, a very solid private equity portfolio. And just as a quick reminder, currently have just under $1 billion invested in private equity, primarily within buyout strategies, which is roughly 60% of that, which is largely split between North America and European buyout managers. And then the remainder is invested in a combination of growth equity, one venture capital investment basis, which just got mentioned, a large fund of funds and some secondary investments and some legacy distress for control. And so just a quick refresher, that consists of 51 manager relationships across about 134 holdings, which are both funds and co-investments. As you may recall from when we talked about the European buyout performance, you have a very solid portfolio overall. You've shown multiples of 1.6x since inception and an average net IRR of 14%. And largely that's been, driven by the maturity, which has been invested in buyout. So again, just this is baselining to say, you have a very solid, well-built private equity portfolio. And going forward, just thinking through how you might make decisions about who you keep, who you'd like to invest with going forward, and who you may think about not re-upping as well. So again, just really a framework for how to think about that. And if you think about it, kind of your private equity portfolio has a core component, which is invested in buyouts. And you'll recall that for the remainder of the year, we worked through the pacing of how much you would need to invest to maintain that, as well as your satellite programs, which is where you're investing in venture capital, growth equity, and also, potentially can do investments in emerging managers. And that's roughly a 5 versus 2% breakout in pacing. And in dollar amounts, that's, roughly around 160 million compared to about 20 million for this year. And again, the pacing is just a way of thinking through what's the actual dollar amounts you need to deploy to maintain your desired target allocations across these two buckets within your overall private equity portfolio. So, actually in spending time talking to Antonio and his team over the last month, as nerdy as I can be about numbers, it's not just really a numbers game. And thinking through kind of who are good long-term relationships, because private equity is a long-term investment, and who you might want to let go as you think through this. It's both kind of quantitative and qualitative. And always I think it's important when you think about private equity, because you are kind of locking up your money for 10 to 12 years, is kind of answering the question, are you better off locking up that money in private equity versus having invested it in those same areas in the stock market? So under the quantitative piece, I think one thing to really think about as you look at these managers and the funds that they've done is, have they generated alpha? Have they outperformed relative to the public markets? And that's an analysis that we do for you and that BAM also tracks. So I think that's really an important number to go to as well. Also, one thing to think about is also just hardcore how much of the money you've invested you want coming back. Because you are kind of taking, you are locking it up for 10 years. And the fancy way of saying that is, are you going to get paid for that illiquidity premium? But it's really, are you going to be compensated for locking up that money versus investing it elsewhere? And generally, for the core portfolio, I would suggest thinking about, at least seeing a return long-term over 1.5 multiples and then higher than a net IRR of 15%. And then also, generally you're looking at the performance at the fund level. I think it's also important to look under the hood and see that, sometimes you may see the same net returns or multiples, but one manager may have done a bunch crappy deals and then hit it out of the ballpark with a couple of them and have that same number, whereas one manager may have done good deals consistently throughout that time. That being said, that's really just consistent deal performance is good to look for as well when you look at these managers. And the other thing as well, how are they making those returns, the value creation? And in buyout, part of it can be done through lowering costs, improving management, or buying smaller companies and add them to make a bigger, better company. Also, because these companies in buyout are borrowing money, there's a component to financial engineering that's involved. All things being equal, you would rather be with the buyout manager that is creating value for you through organic growth or adding other complementary companies versus just really being good at borrowing money, paying down the money when they sell it. And that's something, again, that, we look at and can actually show you how that breaks out through a value driver bridge. And to put it in less fancy terms, it's also important to understand, are they overpaying for these companies when you buy them? At the end of the day, this business consists of buying a private company and selling it. So, if you buy something that you've overpaid for, it's going to be harder to sell it as a profit. And you can compare that by looking at what they are paying for given companies in a sector relative to what those values are in a public market. And you can see with certain kinds of managers, given that they're sourcing, they're not going to go into a big fight off in an auction and just overpay to get a company. And those are also good managers to stick with. And then also, how, your expertise in banking is going to be different than expertise in car manufacturer. So looking at if a given private equity manager has real expertise in certain industry sectors, and are they, say, really good in doing this in Germany versus the US or Canada? And those are all things that you can, think about as you look at these relationships going forward. And then also co-investments are a good way of, getting more exposure, usually at either reduced or no cost. So, do you want to partner with managers where they will regularly show you the ability to upsize the amount you're invested in when they buy these companies? And I think also qualitatively, some things to think about. Is this manager fair and transparent around the actual cost and fees that are involved? And also, do they put their own money into these funds along with your money? So is there good alignment of your interests? Also, many of these managers manage other businesses, private credit, infrastructure, and so forth. And potential conflicts can come up, especially, involved with financing of companies. And you want to be with someone that says, okay, here's a potential conflict. Here's how we're thinking of mitigating that. And the New York pension system is a large and important on, and it's on most, across your 5 pension systems. You do sit on the advisory committees, and something that we do as Axia, which I'm involved with 3 other partners, is reviewing those conflict of interest notifications, really digging into what's involved and if they're actually being mitigated. And that's part of what we offer you. The other thing is, people have different capabilities, in doing deals, be it buying companies, buying buildings or so forth. And that there is a consistency in that. And also you want to be with groups that have not only good deal makers, but there's stability. They are also being fair and incenting their junior folks to stick with the firm. And that's usually done by giving them, either a bit of ownership or carry in it. And that's an important feature to look at. And then also, I think, given the very clear objectives that MERS and the New York pension systems have around investing in NWBE managers, really understanding, are they doing this in a real way or is it performative? We had this discussion with Blackstone. And, BEARS has really been in a leadership position around this. They have gotten the very best group, Lenox Park Solutions, for analyzing and tracking DEI information that really is impactful. And so I would also suggest, exploring if, the manager, if they haven't done it already, are they willing and will continue to participate in Lenox Park so you can track over time. You may hear people say we're at a low baseline. Here's what we're doing. Well, Lenox Park is a great way of tracking that to see if they act on what they're telling you here in this boardroom over time and seeing those changes, both at the firm and at the portfolio company level. And then also given the net zero initiative, many particularly large PE firms that now actually are going through and measuring the carbon footprint of the companies they're buying. And then as part of the value creation, seeing if they can reduce that. And so again, these are just all things to think about as you look at the managers you currently have and think about investing in them in the future. And again, that was largely for private equity buyout. And your satellite portfolio, it's kind of the higher octane portion of it. So there again, I would encourage you to think about setting a relatively higher bar for the returns and the capital returns that you're seeking. And again, I think seeing if they are generating alpha over time is important because just like with buyout, you're locking up your money over long periods. And here too, we talked a little about this in relation to the Grosvenor real estate platform. As you think about making investments in emerging managers, looking at who are the people that are setting it up, what their performance has been at other places, just number wise, but also are they folks that can ultimately run a firm successfully as it grows and becomes institutional quality. There are folks that are great at doing deals to buy companies or trading, but they may not be that terrific when it comes to managing and building a firm. And particularly in venture capital, there's this phenomena of you have the most creative, insightful founder really hits the technology and understands it on the nose, but he or she is terrible at running the company. And so you want to partner with a venture capital manager that ultimately can augment that and bring in folks that can carry that company forward. And again, like in growth equity, a lot of the value creation is very similar to what we talked about in PE. But in venture capital, a lot of what you're looking at is really just the track record of people that are starting those companies up. And then I would say qualitatively, we've just gone through a period where, if you spit within a venture capital startup that made money, and those days are gone. And that was built around this idea that it didn't matter, business fundamentals and making money didn't matter. It was just getting as much market share as you wanted to. Those days are gone. So
to that point, I think operational due diligence is super important. And what's your maybe you could describe Axia's mechanism for how you guys go through ODD a little bit?
yes, in addition to our investment team, we have an operational due diligence team that's run by Simon Floodgate, who is one of the founding partners at Axia. When I was a youngster. I actually worked with him and our other founder, Jim Bose at Credit Suisse. And Simon has over 25 years of doing operational due diligence, looking at conflicts of interest, seeing if the valuations are real and can be verified, or is this magical thinking? And Simon's very humble, but I will tell you the reason that Credit Suisse didn't have exposure to the Madoff scandal was largely because of his group efforts. We're looking at that operational piece. It was like, no, none of this really makes sense or has a reality basis. And so that, and I will also share with you just recently with another client, our ODD team goes and looks at it at the asset and the company level. There were issues of fraud that the manager, the GP, was not that willing to disclose to the LPs. Simon's team found it. And it got raised across all of our clients. And
he didn't have coverage protecting CS and other areas. So
and so I will say our ODD is as robust and thorough as the investment piece, because it matters. Honestly, people may say conflicts of interest, conflicts of interest. No, that piece can derail the money you invest as much as straightforward investment consideration.
We have a hand raised, Al.
Yes.
Antonio, this question is actually for you, but I have a memory. Does AXA due diligence, either operational or investment side, re-up private equity potential investments for BERS? I thought they didn't anymore.
For private equity, yes.
Okay.
So for PE, yes.
Yes, we do. Yeah, and so, so again, both of these kind of buckets, thinking about the more quantitative part around, wanting to see profit generated relative to how you put your money to a public investment, thinking about, picking startups, which are higher risk in the relationship between a founder's track record, and then having a manager, a GP that can guide them successfully to ultimately become a public company or be bought by another private company or a strategic, is important in this arena, which is a little bit different than buyout. But these are all things I would encourage BERS to look at as it thinks through the relationships that it wants to retain, both within buyout and in the satellite portfolio where you're investing in VC growth equities and coaching managers.
one last question, in terms of, this might be random, but I know certain managers will put their capital to work quicker than others. Do you guys track the timing of the implementation of the assets and possibly, I know a bunch of firms return capital early. Obviously, if that money's coming back, it's value because that's money you get to put back to work.
Yes, and that's actually tracked through the distributions. And particularly in buyout, there's been, I would say, an aggressive use of credit lines to do the investments to make the returns look better. And so not only do we track the distributions, and that being said, I didn't point that out explicitly, you want to be with a manager where the DPI is always over one, because that means the money's coming back over the reasonable time horizons for these strategies. And then we also do analysis to see how much of the returns are being altered by just the way you use these long-term unsecured credit, which these days can almost add 2 to 3% in a net IRR, which is again why I would say pay attention to multiples, pay attention to alpha and DPI. But again, these are just things to look at. It's up to the team and your guidance as we move forward with the private equity portfolio.
Thank you, Sandra. And like I said, this wasn't a recommendation. This was just thinking about preparation for the portfolio construction decisions over the next calendar year, and thinking about the implementation of the proposed asset allocation again, because it has not been passed yet, and so but should it be passed, already thinking about what implementation looks like.
Sorry, Antonio, can I just ask a quick question? I couldn't find a copy of this presentation in the packet materials. Is it possible to recirculate it?
Yes, absolutely.
I know, I'd like to see it, and I know, the private equity asset team here at Bureau of Asset Management would like to see it as well, since
Absolutely. Absolutely have a copy there. Yes, you'll have it right after this meeting.
thank you.
Absolutely. So, so there's one last item for, consideration and discussion. As a lot of you guys know, this is my last meeting. And so I am,
We didn't want to be reminded.
Is that in a physical sense?
yeah, physical, not in the mental sense though, not in an emotional sense, just in a, actual sense. But so, look, I don't want to take too much time. I know we've had, we have some time, but I wanted to, I was thinking about what to say last meeting before I go. And I actually was thinking about something that, my first hire said, when we were doing an IPS and, we're putting the IPS together. And Evelise Vargas, who, if you know her, she's a freaking star. And we were talking about kind of what, if you want a culture on a team, you want a culture, anything, what would it be? And she used this term, I thought it was so great, a culture of research and inquiry. Gosh, she's good. I was like, man, that was mine, so I'm taking it. And, look, I think that's what we wanted to kind of create here. And so I as transition, wanted to think about what that means for a particular department in this context, in this governance context, in all of this. And so what I think moving forward is important to maintain as we move through this transition. And so I divided this into a few parts and really thinking about what I thought was the most salient reasons to exist, for us to exist, right? And so I want to start with asset allocation and portfolio construction. And I think, there's a couple of things that I think we're really proud of. The first is the fact that we have an executive committee, right? That took 2 years of a lot of work. But that we incorporate liabilities into our analysis. Please continue that, right? That because it gets at the fundamental goal of a pension plan, which is to pay what we promised to the folks who work hard in our schools. And so that includes the investment liability risk that Salil worked on, the funded ratio analysis, asset liability analysis that that Siegel Marco led, the cash flow analysis that the actuary led. Make sure that that's always part of your analysis, because if you get that stuff close to being right, then everything else kind of will I think will work itself out. How do we balance indexation and policy goals? I'm taking quotes from everybody. So this quote is actually from the person who's the CEO of Hermes. And I'm paraphrasing a little bit, but he said, beta is cheap and stewardship is expensive. So we can get the market for cheap, right? We can get the index fund for basically free. But stewardship is expensive. That being a steward, whether it's your time or money, looking after a plan and understanding what is best for your members, for the sponsor, for the board, for everything is expensive. And it's a lot, right? It's a lot for you all, the ultimate decision makers, to deal with. So just keeping that in mind, and how do you balance those costs with the expense of time and effort and money with regard to being a true steward. Use active risk as a framework. And again, active risk is a particular term, you tracking error or whatever, but think about every action as a spending of your time and risk budget, right? And so we have through the analysis of our capital market expectations, we understand that, ultimately we could probably there's a chance we might get there just doing a passive portfolio, right? And so if we want to outperform that particular benchmark in a variety of metrics, again, we have the overall policy goal benchmark, but we all benchmark with regard to diversity and inclusion. That means you have to look different, right? And if you look different, understand that looking different, you have to take the upside with the downside with that, right? If you're going to look different. And so just keeping that in mind and using that as a framework of how you spend it and where do you think you have an advantage from that. Another thing I'm really happy about is the technology and platforms. And I would implore this board to maintain the portfolio analytics platform. And I think why this is really important is that all stakeholders should come with insights, right? I love cooking clothes. This one is, you outsource implementation, you do not outsource understanding, right? And so the understanding of kind of what's going on, and I think the only way you get there through information. And so having some type of insight is really important and allows for, I think, better and higher level conversations with the folks implementing your portfolio, because you can ask meaningful questions. Maintain insights, not just on the kind of overall portfolio performance, but Lex Park, Clarity AI, so the ESG and DEI platforms, again, having information at the table at the beginning of the conversation. One other thing that we've explored, and again, talking with Sandy and Salil and Kristen and the rest of the team, a kind of a SaaS-based funded ratio modeling platform. Like, there's only one Salil at this table. Although there are other folks who can do some of this stuff, I know, but that works for BERS, directly on payroll, right? I should say, because we have some rocket scientists here, like literally. What I mean is that, but in order to continue that conversation, having some insights, again, directional analysis around the funded ratio and what different capital market expectations and what different benefit regimes, inflation regimes will do for our funded ratio, I think is important, a particular consideration. As far as manager selection is concerned, Sandra gave the presentation on private equity manager consolidation and pacing slowdown. It's tough. Like, how do you maintain the minimum commitment in the context of slower pacing, right? Do we revisit the minimum? Maybe the minimum looks a little bit different. And so that's a conversation to have, but that's just something that I think everybody should consider. Active and passive split, right? What percentage should be an index versus active management? That's a conversation you should have. And then how do you balance fewer commitments while maintaining the diversity and climate ambitions? That's not an easy problem. I'm going to tell you that right now. And so I do not envy those decisions that folks have to make. And then finally, I think thinking about research and insights, right? Always for something novel. I think the payoff on that can be astronomical. So with regard to climate and portfolio construction, we're working on certain things now. And again, at the end of the day, we have limited budgets, but in figuring out how to maintain a toehold in thinking about research and coming up with novel insights, I think are really important. It's something that we tried to inculcate. I enjoyed this, guys. Thank you for having trusted me. I'm gonna miss this, and
Before I stop, a question for you. What was the funded ratio when you got here?
Look, Tony, I know where you're going with this, and I appreciate that.
Excuse me, I'm a board member. You're still thinking, right? So, just a question. What was the funded ratio?
Good. Like, look, when I got here, BERS' funded ratio was high 80s, low 90s. Like it was a good funded ratio. Like, so so it was about in the high 80s, low 90s. Yeah.
Just as a newer board member here, I just want to tell you how much I've appreciated working with you. And you're a gentleman. I love when you giggle over algorithms. I know how much you really love this place, and we're gonna miss you sorely, and we wish you all the best.
And I just wanted to say, before you clap, Antonio, you put the human factor in this place. You put the ability as a Black woman, a Black entrepreneur, to feel comfortable at the table. And I'm a stickler for words and the undertones of what people say when things are too complicated and you just don't understand. That is code. And I'm serious, because you taking those moments to break things down, to say it's more important to be clear than clever, that I am you, you are me, my salary's a little different, but I need you to get this because I'm about it. I'm like, okay, people say that, but I'm gonna say that you have demonstrated that. And so that in lunches, and you sure you can ride over to sit and talk? I'm a little verklempt. I'm a little verklempt because it's not what you say, it's what you did. And I am very, very grateful for that. I really mean it. I'm getting a little teary-eyed, but I'm a female, I can get away with it. I just I want to thank you for being so available at all costs. And last point, giving information and then asking people, if you do not understand something, you call me. That's impeccable. Thank you for making me feel special, especially people who were new to this field. I appreciate you. Now you guys can clap because he.
On behalf of the membership of BERS, who I represent, we all are better off for having you. We appreciate you.
Donald said his glove.
Can't top that, but I have to say that, it was kind of a surprise being part of BERS when I came onto the panel. I said, oh, great, I gotta learn all the educational issues and I think I could get a handle on that. Then I think in passing, someone said to me, by the way, you get all the education stuff, but you're also in BERS. What is a BERS? I had no idea. I remember we were online, came to the first meeting, did not understand a thing that was, I said, what are they talking about? And, you demystified a lot of that and made it, comfortable so that we could feel like we, even though a lot of the stuff, that we could feel comfortable in this area and ask questions. Your patience with some of I know my rookie questions because I had no idea. What are you?
Right.
You seem to understand it because sometimes you would actually tell yourself a joke with the numbers and laugh. It must be funny, but it was kind of.
I hear you, it was.
I'm certain it was funny, but only it was a lot of graphs and charts and then you found it like interesting and I was like, wow, I guess it's funny. So, yeah, so that was, that was really appreciated.
You do so great.
Thank you, sir. Thank you, sir. Yeah, I appreciate that.
I think that what you're seeing here is that within a very short period of time, we all became Rodriguez disciples. We all followed and trusted your judgment. I think on a lot of, I think I even whispered at one point, I'm trusting you to keep me out of federal, something world here. Because I don't know, I'm voting and I'm trusting, but that we could have that trust. That we could feel comfortable in knowing that where you were guiding us was gonna be the right direction and that we would come out with a good outcome. As I think Anthony was trying to allude to, where that, you could look back and say, we've progressed, over the time and that it made a difference. And so I think that's unique. I'm jealous for the other group. I know they're gonna get somebody great.
I'm not.
Hey, you got it's good. It's a good move for him, but. Huh?
He may not be here, but he's on dial, so.
Listen.
That's
Let me explain.
Very good
I
point.
do not understand this.
Yeah.
So can you explain this to me?
Yeah.
Thanks.
So I guess that means we'll be calling you sometimes.
Yeah.
But again, I think we all want to say thank you for
Absolutely.
your time
Put that-
and wish you well.
And wish you the
Wish you
best.
well.
As you teach and you learn, like I peeped you. It is so important to pick up the torch and understanding that this industry is not a passive one, it's an active one. And there is an exchange of learning as you go. Again, I've watched and I've studied you and I was like, wow, every organization needs to have a you because you have this is the facts, excuse me, this is what we're focused on and this is the teaching part. And not everybody rolls like that. And I'm a founder of a non-for-profit. I know what things look like, and I'm sorry, I'm gonna stop talking. I'm gonna let you go.
So after all that, you want to stay, right?
Antonio,
Thank you, Dan.
Oh, here we go.
Antonio,
Yeah.
from BERS Executive Management, of course, we want to say thank you. Come a long way from meeting you with 6 years ago, common meeting. Who was that smart brother talking over there? And got you on the BERS from, nothing we had today to where it is now. I want to commend you for the work you've done. Much appreciated. Seeing your kids grow up. You're a great dude. I really appreciate you. Good luck in the future.
Daniel, thank you so much. Thank you for approaching me at that sim. Thank you for approaching me at that meeting.
And, if I may have, from Axia, not only do we appreciate talent, that you've displayed over time and how that's reflected in helping BERS, but also your integrity. And I think that's very needed and necessary, and I hope combination for a great public servant such as you've been. And I wish we could clone you and have more of your type of talent and integrity across more systems. So.
And I think from Siegel Marco's perspective, it's been a pleasure working with you side by side. I mean, I remember meeting you at the Zoom before you were at BERS. And I think that the structure you brought, it's really not in every public plan. And I wish that it could be cloned in every public plan in the US. Because every participant would be better with a structure like the one that you created.
Thank you.
Make sure you get a copy of this.
Lose the business for today's.
Actually, if it's all right, if I can also pile on and just thank Antonio for his potential, for his partnership, for making me feel welcome at the Bureau of Asset Management when I first joined 13 months ago. I think you've been a pleasure to work with, Antonio. I wish you nothing but the best. We have each other's number on speed dial, so Godspeed and good luck in all future endeavors.
Steve, I appreciate all the conversation and the advice. Thank you. Thank you. Right. With that, right? All right. I appreciate it, guys.
John's motion to adjourn.
Yes, and then it concludes the business for today's executive committee meeting. We now need a motion to adjourn. John, so move second.
Second.
All right. Any final discussion? All those in favor, please say aye.
Aye.
Any opposed? We are adjourned. The next executive committee meeting is scheduled for Thursday, October 12th, 2023. Have a wonderful rest of your day, and I will miss you all.